When you think about the backbone of the global economy, you have to think about the companies that literally pull the raw materials out of the ground for everything we build. Today, we're putting three of these absolute titans in the ring: Vale, Rio Tinto, and BHP. They're all giants for sure, but as you'll see, they offer wildly different opportunities for investors.
So let's say you've got to pick just one. Where do you put your money? It's a really tough question, right? It pits pure value against rock-solid safety, and a huge payday against smart diversification. In this explainer, we're going to break it all down to help you figure out which one of these giants actually fits your playbook. Okay, let's dive right in. The best way to start a showdown like this is to just put the numbers side by side. We're going to look at the hard data using projections for 2025 to see how these companies really stack up on paper. And boom, here's the tail of the tape. You can immediately see three totally different investment stories emerging. You've got Vale, which is by far the cheapest on a price-to-earnings basis and pays a monster dividend, but it also comes with the highest risk. On the other end, you have BHP. It's the most expensive with the lowest dividend, but everyone sees it as the safest bet. And Rio Tinto? Well, it's sitting right there in the middle of the road. The first thing that just jumps off the page is how different the price tags are. A PE ratio is basically what you're paying for $1 of a company's earnings. With Vale, you're paying less than $6 for that dollar of profit, but for BHP, you're paying almost double that. It makes Vale the undeniable bargain of the bunch, at least on paper. So, you see the price, but what do you get in return? Well, that's the payout. The dividend yield is the actual cash the company hands back to you as an investor. And look at Vale. It's an absolute powerhouse, almost touching a 10% yield. That's literally more than double what BHP is offering. This right here is the reward you get for taking on that higher risk we just mentioned.
Okay, let's zoom in on our first contender. We're talking about Vale, the high-yield, high-octane player in this showdown. This is the one that offers both incredible value and, yeah, significant risk.
So the case for Vale is actually really simple and powerful. You get the biggest dividend, you get the cheapest stock, and that means it has the most room to run up in price. But there's always a catch, isn't there? The big one here is that it's based in Brazil, and that brings the level of geopolitical risk that makes some investors, well, a little nervous.
And here's the key argument you'll hear. The thinking is that the market is just too nervous right now, that investors are being overly cautious about the risks, and that massive, near 10% dividend, it acts like a huge safety margin. Basically, you're getting paid really well to wait for everyone else to realize that Vale might be undervalued.
All right, next up in the ring is Rio Tinto. Now, if Vale is the aggressive powerhouse, you can think of Rio Tinto as the balanced, all-around athlete of the group.
Rio Tinto's secret weapon is its smart diversification. Sure, it's a huge iron ore player, but it's also heavily invested in aluminum, which is crucial for things like lightweight vehicles and planes, and copper. This isn't just about not having all your eggs in one basket. It's a strategic move that gives it a more stable, medium-risk profile. Of course, that stability comes at a cost, a lower dividend than Vale, and maybe a little less explosive growth potential.
And this really nails it. Rio Tinto is your bet on the future of metals like copper, which are absolutely essential for the entire green energy transition. It gives you all that exposure without forcing you to pay the really high premium that comes with our final contender.
And that brings us to the fortress of the mining world, BHP Group. This isn't just a giant, it's the largest, most diversified miner on the entire planet, and believe me, it is priced like it.
BHP's big advantage is its incredible diversification. I mean, beyond iron ore and copper, it's a huge player in potash. And what's potash? It's a key ingredient for fertilizer. So BHP is basically making a bet on the future of food. All of this makes it a safe haven asset. But that safety? It's expensive. You're paying the highest price for the lowest dividend of the three.
So who is this for? Well, this defines its audience perfectly. BHP is for the patient, buy-and-hold investor. You're not trying to double your money overnight here. You're looking to protect your capital and get that slow, steady growth over the long haul.
Okay, so we've looked at the numbers, we've heard the stories behind them. Now for the most important part. How do you pick the winner that's actually right for you? Look, the right choice here depends completely on your own personal strategy. If you're an income hunter looking for maximum yield and you think the market's got the risk wrong, then Vale is your contender. If you want a balanced approach and you're bullish on the metals of the future, then you look at Rio Tinto. And if your number one priority is safety, sleeping well at night, then you build your foundation on the fortress, which is BHP.
So at the end of the day, it's not about which of these companies is the best. It's about which one is the best fit for your goals. So the real question you have to ask yourself is this: are you investing for yield, for balance, or for safety? Your answer points you straight to your winner.